3, 2, 1. We're live.
Hello guys. Hello guys, my name is James Mbugua, an educational partner at FX Pesa. And today we are going to learn about technical analysis 1, that is decoding the chart 1. So when it comes to technical analysis, is a trading discipline employed to evaluate investments and identify trading opportunities, trading activity, such as price movement and volume. So when it comes to this technical analysis, there are three main principles or assumptions that we normally use. That is, the market discounts everything, price moves in trends and counter trends, price action, that is downtrend, up. So we want to know how to trade the three tradable movements in the market. So we're going to learn about trading with support and resistance. So when it comes to support and resistance are two basic concepts that form the basis of technical analysis. So the two terms are used by traders to refer to price levels on charts that tend to act as a barrier beyond which price So the two terms are used by traders to refer to price levels on chart that tend to act as a barrier beyond which price is unable to penetrate. So we are going to use support and resistance to predict the potential direction in the market, to determine an ideal market entry and identify a suitable exit point. So most of the time when it comes to this financial market, you will find that the chart is always repeating itself over and over again. Either it's on an uptrend, a downtrend, or a sideways movement, is by drawing some referral or some lines or some zones that will help you to identify if the market has a demand or a supply. So we normally use the support and resistance. They are just two lines that we normally draw to act as a point to refer or a point where we should take the trade and exit the trade. So let us touch on a support. Support is an area or a zone on a chart where price drops too severely without breaking below. In the theory, support is the price level at which demand, in brackets buying power, is strong enough to prevent the price from declining further. So the rationale is that as the price gets closer and closer to support and becomes cheaper in the process, buyers see a better deal and are more likely to buy at that price. So if I may give an example with what I have as an example of support, you're able to see that in these zones, this line, it does not represent the specific price. Example is, if this price was dropping down to 100 level, that does not mean it will come back to 100 level and then bounce off. So we're just using it as a zone or as a line or an area that acts as a point of reference. The second time should be at least should act as a confirmation to you that the third touch we are going to push the prices to the upside, or we have a strong demand on the support. So most of the time, it's like when I say 10, 20, 30, you're able to predict the next digit will be 50. So that means if here there were buyers willing to buy this market and they bought it, the second time, the third time should act as a confirmation for you to take a buy position. What it entails is that we need to be keen also with these support levels, because sometimes we'll come to learn about the breakouts. So let us see about a little psychology about the zone. So sellers become less likely to sell since they are getting a worse deal. In that scenario, demand from buyers will erode supply from sellers, and that will slow price from falling below support. So anytime the market comes here, it will be pushed up. The second time it was pushed up, so that touch, you know that on an uptrend or on a side, it will push upwards, that is. So let us see another line that we normally have. It is the resistance. Remember, the support and the resistance level or zone, we are going to use them on a ranging market or a sideways movement. So we have another key important zone or area, that is a resistance. A resistance is an area or a zone, is an area on a zone on a chart where the price has risen too severely but has struggled to break above. As I may give an example, we have such a zone at this point where the price has risen too severely. The first touch, the second touch, the third touch, we can see most of the time, once we have the first touch, the second touch always acts as a confirmation to us that, yes, we have a resistance area or a zone. So when the market comes to the third touch, it will definitely sell off. Also for the fourth touch, it will definitely. Resistance is the price level at which supply, that is selling power, is strong enough to prevent the price from rising further. You can be able to see that the representation of the candlestick, it reaches to some point that they are not able to penetrate above, or they are not able to go above this area or this zone. So we first note down that this is a strong area or a strong zone where buyers, they are not able to push the prices any further. So the rationale behind this is that, or the psychology is that the price gets, when the price gets closer and closer to resistance, it becomes more expensive in the process, and sellers are more likely to sell as buyers become likely to buy. This resistance zone or area, it shows the presence of supply. On the support area that we learned a few minutes ago, it shows that there is a very strong demand. And once we have demand on this support area or zone, there are buyers willing to buy the market, and you should take part in buying that market, because we want to buy at the lowest price. Remember, we buy low, you sell high. So this is the lowest price where we should buy this market when it is ranging, or when it is in a neutral movement, that is. So on a resistance area or zone, this is where there is supply. There are sellers willing to sell this market at these highest prices. So these act as our highest prices in this case. And then when you come across this structure on your MT5 or any trading platform, you will know that this is a point where buyers are trying to push the prices up, but there is a lot of supply. So if there is supply, you become part of the sellers to sell the market. So we want to see, yes, we're saying about resistance and support. How can you trade if you come across such a market in the chart or in any trading platform? So how to trade support and resistance. That is a ranging market. So range tends to appear in a sideways trending market where there is no clear indication of a trend. When the market is range bound, traders tend to look for long entries when price bounce off support and short entries when price bounce off resistance. So it's important to note that the level of support and resistance are not always exact price level, which is why traders should consider setting stop loss below support when long and above resistance when going short. So right before I have a range market or a sideways market, and according to the explanation or according to the tested data, it shows that when the market comes to the resistance, we have presence of sellers. When the market comes to the support area or zone, we have presence of buyers. So the market seems to be in a neutral move, that is. And how you can trade this, you don't have to trade this market if you don't have confirmation. Don't trade this market if you don't have confirmation, that is. So if you have first confirmation, second confirmation on the top, and also first confirmation and then the second confirmation on the bottom. So you can try to react on the third confirmation or any other point, and you be keen while trading of something that we call breakout. We'll get so if the market comes to the resistance level, you wait for it to give you first confirmation, second confirmation, and then the third confirmation. You can take a clean and a valid sell up to targeting the recent prices. The recent prices are these zones. So remember, don't trade in the middle of a ranging market. Always be patient and wait for the market to come to you. That is, you be patient for the market to come to the resistance so that you can take a sell position, because the psychology about the resistance is that we have supply. You wait for the market to come back to the support zone or support area, because on the support area or zone power. So the two lines, they normally act as a point of reference. Don't forget that they don't represent an actual price. So the two lines, you're going to use them to at least try to draw them on your chart. And then you will be able to trade a range market. So on a ranging market, we are going to use the horizontal line. We draw it on the upside where the price has risen to severally. And then we also use the same horizontal line on the MT5 to draw the support area or zone. So I want to see, because this normally happens on a sideways movement, what about the uptrend and the downtrend? Because this market is not trending. This one is a ranging market. We only have two trends, that is uptrend and downtrend. So when it comes to uptrend or a downtrend, we normally use something we call a trend line. A trend line is just a line that attaches the pivot highs and the pivot lows. So we connect the higher highs and the higher lows. We connect the lower lows and the lower highs. So trend line. A trend line is a diagonal line drawn over pivot highs or under pivot lows to show the prevailing direction of the market. In a strong trend, price will most of the time bounce off the trend line and continue to move in the direction of the trend. So we say that we normally use these lines as a point of reference. So as we see the example on the screen, we're able to see that it is just a line that attaches the higher lows if this market, when this market is on an uptrend, that is. So we see when the market came at this trend line, it was pushed off. It shows there is demand, that is. When it came back again to that trend line, it pushed off the prices. And we said that we want to buy this market on the lowest prices as possible. So the trend line will give us the lowest prices for us to buy this market. So this movement normally occurs on each and every pair that we normally trade day in, day out. And you're able to see, we had the first touch, the market pushed up. We had the second touch, the market pushed up. The third touch, the market managed also to push up. So we had enough confirmation that we are going to push the prices up if it comes close to our trend line, or if you are afraid to take the trades which the market has not touched the trend line, you can see that if you have patience of waiting and trading the valid things, the market definitely came back to that trend line and then it pushed off. So this is an example of a trend line. It is just a line. So this does not mean the market will every time respect the market. So you should be very important why you should always use a stop loss while you're trading. That is. So traders can therefore use trend line as a point of reference to enter trades in the direction of the trend as the price pushes further away from the trend line. So most of the time they say the trend is your friend, but it is not easy as you think. You can find an uptrend on a daily time frame, but when you go down a downtrend, so it needs a lot of commitment and consistency, that is. So you get to learn more about the history, whatever the history was doing. Even nowadays in this financial market, we are still trading what had already happened in the past. So let us see a trend line, how you can draw a trend line attaching the lower highs. You can see, guys, once this trend line, this example on the screen was drawn, it was used as a point of reference. So you can try to draw attaching these points, and then at least you have another confirmation on the upper side to show you also the market has finished creating a higher high, and it will be, and you will have patience of waiting for the market to come and create a higher low so that you can take a buy position. So the same trend line drawn on a downtrend, you're able to see the structure for a downtrend movement. We say that it is a lower high, a lower low, a lower high, a lower low, a lower high, a lower low, and a lower high. So on a downtrend movement, we normally focus with selling opportunities or taking sell orders. So when the market creates a lower high, we know that the market will push to the downside, or there is supply at that trend line. So how will you know that the market has created or it has finished creating a lower high? It is by drawing a trend line that will act as a point of reference. You're able to see, guys, once we have the first touch, we had the second touch, the third confirmation, that touch will act as a confirmation to you that you should take a sell position. So we want to see, because the market cannot be trending on a sideways movement, or it cannot also be trading on a uptrend or a downtrend frequently. So that means we normally have something we call breakout or break of the structure. So if the market broke this structure of a downtrend, what are you going to do? You're not going to sit by your hands. You're not going to just watch. You're going to at least go through the market and see what happens when the market does not respect the trend line or the resistance and the support area. So we normally have breakouts. A breakout is a significant price movement beyond a defined support or resistance area. Traders often look for breakouts below support or above resistance in order to capitalize on further acceleration in one direction. If this momentum is strong enough, there is potential to initiate a new trend. The safest way to trade a breakout is to wait for the market to retest support and resistance. That is a pullback. You wait for the market to do a pullback so that you can take a buy order before executing a trade. In so doing, fake breakouts can be avoided. So I want to see an example of a breakout that has broken a resistance zone or area. We're able to see that not everything is perfect when it comes to the financial market. The market normally traded, it is imperfect. So the market moves in cycle. So it does not move in straight lines the way we normally draw an uptrend, higher high, higher low, higher high, higher low. It moves in cycle. So we know when the market was on a neutral movement or a sideways movement, we might experience a breakout. And that's why we normally advise people to place a stop loss above, so that when the market does not, when the probability does not play out, you won't lose or you won't expose yourself in the market. So we see in this chart, this is a resistance zone. And we say that a resistance zone or area, a resistance is an area or a zone on a chart where price has risen too severely but has struggled to break above. So what happens when it breaks above the resistance? It shows there is accumulation. So it shows that there are buyers, there are more strong buying power at this state. So the only way to trade this one is not to chase the prices. Don't start buying once the market has broken out of resistance area or zone. You wait for a clear retest. You see the market has done a retest. And once we have a retest, we know that the market has now came out of a sideways movement. And now we are having an uptrend movement. And you can be able to see, guys, once you are patient with the market to come to you, the prices to come to you, you'll be able to take valid trades, and you will be able also to have some time to wait for the candlestick to close. So you wait for a breakout. Once you see a breakout on the retest, you wait for, once you see a breakout on the resistance area or zone, that is, you wait for a clean retest, and then you can take a clean valid buy setup. So we also have a breakout of support, that is, we also have a breakout of support. So the market, a support is an area or a zone on a chart where price has dropped too severely, but has struggled to break below. But once we come across a breakout, or we have taken a trade at this point, and then the market respects our analysis for a while, and then it breaks that support, that is, you don't start selling the market. Yes, we have come out of a sideways movement or a ranging market. The market broke, you wait for a clean retest, that is a pullback. So once we break out of a sideways movement, we now start having a downtrend movement. So we now start creating lower lows and lower highs. This lower high will act as a retest. So once we have changed the there is a downtrend. So that is after we have broken the support. You can be able to see these prices, they normally repeat over and over, even in the live market. So we had a breakout, and we also had a clean pullback, that is a retest, and then we had a continuation. Once the market breaks out of the structure, it does a pullback, it sold off, it came again, did a clean pullback. You can take a sell position on these pullbacks or this retest. So what happens when we break out of the support and then or resistance, and then we don't have a retest? So that point is here. So you can see that at this is our point. This is a support zone or a support area. The market came, the first touch, it went up, the second touch, it went up, the third touch, it went up, and then we managed to break that support zone. So once we broke out of that support zone, we didn't have a retest, that is, the market just only showed a down, or it showed that we have a strong selling power, which managed to just continue pushing the prices to the lowest, to the downside, that is. So once you come across such a move, you just know that we have changed the direction of the market, and now we have started trending on a downtrend. So we have now started creating lower lows and lower highs. You wait for the market to break this lower low, and then once it creates a lower low at this point, you wait for the market to create a lower high so that you can take a clean sell position. That is if the market has broken the support area or zone. So we want to see on the live chart if what we're explaining here, we can at least see it on the live market. Give me a second. So when I go to my MT5, when you go back to my MT5 and I open any pair, you're able to see that this is Audi USD, AUD USD. When I go to the one day time frame, you're able to see we had an uptrend at this point. The market was trending on an uptrend. It was creating higher highs, higher lows, higher highs, higher low level, creating lower lows, lower highs, lower lows, lower highs. So at some point we had a sideways movement that is on this part. We had, this is where you use this horizontal line. You drop it at a point where the market has risen to severely, but has struggled to break above point. Right here. And also you use the same horizontal line at this point. So the market was coming at this point and then it was dropping down. It came for the second time, it dropped down. For the third touch, you could have taken a clean sell position. You can be able to see, guys, whatever we are seeing is that the market is always either trending on an uptrend or a downtrend, or it is on range bound movement, that is also sideways movement, that is. So you're able to see. So there are many things that you will come across this chart and you'll get familiar with everything as time goes on. So thank you, guys. My name is James Mbugua, and I really appreciate for your time, for being part of the session. So when it comes to, I'm seeing this code is asking about the top-down analysis. That is for another lesson, that is. So when it comes to top-down analysis, we normally use the higher time frame down to the lower time frame to find an entry. So you can be a trader who is a swing or a scalper trader. If I may give an example about a scalper trader, you can start with 4 hour to identify the key important points. That is the strongest support or the strongest resistance down to 15 minutes so that you can have an entry on the right zones. So thank you, guys. So my name is James, and I really appreciate you